us. You're watching Investor's Guide on Mirror Now, and I'm Avni Raja. This is a show where we break down personal finance for you. No jargon. We cut out the clutter and help you understand how best you can manage all of your investments. And we are focusing today on mutual funds and what are the parameters you really need to keep in mind before you go ahead and pick your mutual funds. And joining me on the show is Feroze Azeez of Anand Rathi Wealth Management. Feroze, thank you so much for joining us. I want to focus today on, some of the more quantitative factors as far as picking a mutual fund is concerned, because let's face it, there are a huge number of fund houses, there are a huge number of funds. Even though there are categories, even for an expert investor, breaking through all that clutter can be quite a daunting task. So let's start, from the beginning in terms of whether there should be any sort of a thumb rule, especially for a beginner, about what's the kind of fund house you should invest in, and when you're looking at a mutual fund, anything that should sort of narrow your region of choice.
Yes, Avni, I think understanding the first basic filters, which narrows the universe. Now, if you speak of equity mutual funds, there are about 450 odd equity mutual funds. You're going to be picking and choosing 5-7 of them. So that's a very large task. Filtering down from 450 to 5 is like 99% of them will get eliminated in the process. So the first filter which you put is going to be very critical. I think the first filter is go to those asset management companies who have at least 3,000 crores of equity assets which they're managing. Because if an asset management company does not have even 3,000 crores to manage on the equity side, it is unlikely that they would be able to spend enough money to hire talent which will actually do in-depth research. So the smaller asset management companies out of the 40 odd which we have to get eliminated because of their asset size. So 3,000 crores and below asset management companies can be ignored especially for a beginner. Point one, that's the first filter. The second filter is the scheme has to have some respectable assets under management. 1,500 crore plus schemes is what you should ideally look at. If you so did, then 80% of the schemes in these two filters would be out, and you'd be left with 80-90 schemes to pick your 5-7 from. So I think these two are very important filters. First one, which I mentioned, Avni, is because the depth of research is larger in larger asset management companies. And the scheme size actually impacts the cost or the fee you end up paying to the fund manager. The smaller the size, the higher the fee you're paying. So I think 1,500 plus is the sweet spot which you should be looking at.
Right, so that does narrow down the universe at least by some amount, making it that much easier. Now, the second part is a little more, qualitative as well, some of those indicators. So we're looking as far as the performance of funds are concerned, looking at the fund manager's performance. So all of these factors also need to be taken into account, Feroze. But here one thing which we very often see is people giving a lot of weightage to past performance of mutual funds. Now, while that is an important indicator, it cannot be the only indicator, because we have to remember that past performance does not guarantee future results, and that is something that I think needs to be reiterated. So if you can just take us through what are the other factors that one should really look at other than the performance of a fund.
You've mentioned the right point. I think past performance is not an indication of the future, and rightly so. We did a study at Anand Rathi a few years back where we saw the top 10 schemes of the previous year, how many of them end up being the top 10 schemes for the subsequent year. And we realized only one or one and a half because, as an average, 1 to 2 schemes out of the 10 which were top 10 last year remain in the top 10. So past performance is not a good indication of the future, but unfortunately, an investor looks at past performance with a colored lens and gives immense emphasis to it. And I think that's one thing which needs to get corrected. Point two, to my mind, if past performance is not the right indication, then automatically the problem is, what do I look at? What else are the subjective elements I can look at to get a better choice? So what can you look at is fund manager. If you chose a fund manager in your portfolio, automatically you will have 144 fund managers in the country, out of which, to my mind, there are only 21 fund managers who are very good. who have proved their capability of choosing stocks. So fund manager tracking is the next thing which you should do. You should look at comparing funds in the same category. You can't compare a large cap fund with a mid cap fund. So if you kept these points in mind over a period, I think the skill of choosing the schemes, not just on the past performance basis, but on a prospective, futuristic basis, you will be able to achieve.
Right. And also the other aspect now, of course, getting into the actual, determination of what is the category of funds you should be choosing based on your goals. So, to put it very simply, if your goals are in the immediate term, in the short term, rather, you should sort of go for debt funds. If it's slightly longer than that, maybe we're talking about 2 years to say 5 years, you could look at once again debt funds and balanced funds, perhaps some sort of a combination. And if they're long-term funds, long-term goals rather, then you need to be looking at equity funds and a combination that includes equity funds. But once again, all of this is based on also on your own risk appetite. So, Feroze, if you can help our viewers understand how this should really be looked at in terms of the kind of category of funds you choose based on your risk appetite and your financial goals.
Yes, I think the strongest correlation of goal, time frame, and the product choice exists. So, like you already pointed out, if you have a very short-term goal, a debt is the only asset which can help you have a very smooth curve. So you can't take equity funds for a 1 year duration, because after 1 year, if you need the money and the markets are not supportive, then you will actually have loss on capital, let alone the return being lesser. So debt helps you navigate the short end of the goals of 1 year, 2 year, and even 3 year in a portion. Equity balanced funds, which have a combination of both, from 3 year to 5 year. If you have monies which are greater than 5 years, then equity would be the primary backbone of the savings which you've accumulated for 5 years plus. Because it's seen historically in several research, and also at Anand Rathi, we've done enough research to figure out that in a 10-year time frame, the worst returns over the last 25 years in most of the early mutual funds of India has been in the double digit. In spite of going through a roller coaster ride in the short term, after 10 years, funds have at least given double-digit returns. So time frames will help you reduce the risk of equity because of holding it for long periods of time. So like you said, Avni, short end, if you have 1 to 3 years, debt can help you. 3 to 5 years, a balanced fund or a mix of equity and debt funds can help you. And anything greater than 5 years, equity with a small component of debt to provision for any exigencies is a good idea.
All right, Feroze, thank you so much for joining us with all of that perspective. I hope at least our viewers have got a sense of how does one start looking at mutual funds and start investing in them. We're of course going to continue with our, getting you the guidelines and the rules for investing in mutual funds even in further episodes. On the next episode, we're going to specifically talk about direct plans versus regular plans and whether you should be opting for the dividend option or the growth option. All of these details we'll talk about on the next episode. Till then, thanks so much for watching.